Do a lot of VCs are heavily involved in the universities? But
They are,
right? I mean, Gavin Christensen teaches at BYU.
Okay.
You are heavily involved with the U, but you've got labor connection. But a lot of VCs, like, even will teach at Stanford.
Yeah.
And so it's my understanding a lot of VCs get university positions. But university students probably, I don't think that gives them a better opportunity to get funded. And I don't know how many VCs actually get funding from other than it allows them to build connections. But my guess is a bunch of those are wannabes. Is it beneficial for a VC, before we dive into
is it beneficial for a VC to engage with the university?
Yeah, for the VC, not for the students.
Well, I think that a lot of VCs that teach at Stanford would argue that if they're able to source a really great deal, they're able to meet a great entrepreneur and build a relationship there, that it only takes one to justify it, right? It's like we invested in Omaze, and the founder of Omaze, Matt Polson, his roommates were the founders of DoorDash and Snapchat.
But did they do that as a student?
I think the DoorDash guys did, yeah. I think they launched as students.
But typically, statistically, the big wins come from what age group? 40 and above? 30 and above?
Yeah.
You'll get a lot of random outliers, but I don't know how many, it's just the thought I had this. So
I don't think that the main motivation for VCs to engage with universities is
deal flow.
Or
it just takes a lot of time. Like Gavin, he has to drive to Provo.
I think it's something Gavin really enjoys. I really enjoy it.
Oh yeah, I mean he can
working with students. I think that in of itself.
I just want to be very clear. I think Gavin's awesome. It was a thought I saw.
You just think he wastes his time. I get it.
So can I go off script? I know you said you weren't prepared for this question, but I think those sometimes create the best podcast. Is what is the future of venture capital? And the reason I'm asking is I was listening to a podcast with Jason Calcanis, and they were talking about how the market is changing.
Yep.
And so for a lot of software startups, software is much cheaper to start a software company now than it was then. It used to be much, much more expensive.
When's then?
Then is, even from 5 years ago, definitely from 10 or 20 years ago.
Yep.
So you can get something off the ground fairly easily.
Yep.
It's now something where individuals can self-fund it, friends and families can self-fund it. I think at that point, angels have more power now than they used to, because I think VCs were kind of trumping them. But some people just need a little bit more cash to get off the ground. And then instead of going the traditional Series A VC route, you've got companies like Pipe that and especially with something like SaaS, where they can look at your revenue, and if your revenue is predictable, you in theory could just say, hey, I don't know what Pipe's terms are. Maybe they take 20% off of a deal that's paid a year in advance, but you don't have dilution. So
to be fair though, Pipe is still early, right? It's still not proven out. It's a fantastic idea. We'll see if it actually ends up working.
You don't think Pipe will work out?
I'm not saying that it won't work out. I'm just saying it's hard to say that though the whole world changed, because we now have this company called Pipe, which has only done a few $1 million worth of transactions so far. So could it? I think it's a fantastic idea. I think there's a high degree of likelihood that it could be successful. But I wouldn't say that now we need to throw out all the models because this company called Pipe exists, right? It's very possible that Pipe could launch, and it turns out that the lending they're doing is more risky than they anticipated, and they have to charge higher rates in order for it to work, in which case then all of a sudden it's not quite as attractive as it used to be, right? So that's all I'm saying. We don't know yet, right? It's just too early to know yet. But yes, no, I agree. It's never been easier to start a company. It's never been easier to raise money, right? Particularly in the current environment where a lot of people are flush with cash. You add on not just Pipe, but you add on the equity crowdfunding environment, which has raised hundreds of millions of dollars for startups, right? So you've got WeFunder, you've got Start Engine, you've got Republic. Republic just announced this huge Series B fundraising, and they're doing everything from equity to NFTs to real estate to video games. You can equity crowdfund anything these days. You've got big funds like Greycroft that just announced a $500 million seed fund, which is crazy. Particularly because they're we're going to write $20 million checks into seed stage companies, right?
Okay.
And I think what you're seeing is everybody is fighting to get in earlier and earlier and earlier, because all of the big funds that used to be only public equities investors, these hedge funds, they've all moved down market into the growth stage. So that's become more competitive. And now they're even starting to move into the Series Bs and the Series As. And those are becoming more competitive, and that's forcing everybody else further down the stack to the seed, pre-seed, that whole thing. So now you've got more capital than ever chasing deals at the earliest stages. And on top of that, it's never been easier to start a company than ever before. And so like, there's this question of like, hey, I can start these lifestyle SaaS businesses that may not really be venture backable. And then other people that are like, no, I want to build like this big scalable thing. And there's a lot of money flowing into it. And you add on top of all of that, this whole concept of blitz scaling that's been popularized over the last few years, where it's like, hey, look, we're going to basically anoint the winners with lots of cash, right? And that's what you see what Tiger Global is largely doing, is coming in saying, hey, you know what? We're going to kind of anoint the winner because we're going to provide them with a lot of cash, high valuation. It'll be hard for competitors to catch up, right? And that makes it tough. If you're not in that company, you're in one of the competitors, that's tough, right? Like, dollars can actually create competitive advantage if they're used efficiently.
Does this keep you up at night?
Does it keep me up at night? I mean, I think the question that I'm always thinking about is, can we move fast enough to not miss out on great opportunities? Now, our funds are a little different, right? Like, I don't have to compete with a Tiger Global per se, right? I'm not leading Series A rounds, right? If I was a fund that was a handful of friends, for the lack of a better word, partners, with very little competitive advantage and a few $100 million in AUM, I think I'd be terrified, right? Where,
like literally terrified, or?
Well, I don't know if they are, but I would be. Like, if capital is my only competitive advantage, right? I'm a commodity in this market. And I think there are a lot of funds that kind of fit in that bucket where it's like, what do you offer that's really unique? Because you have funds that will offer you speed. You have funds that will offer you expertise. You have funds that offer you brand. And if you don't have all those, like at least one of those in spades, like I think you're in a tough spot.
Am I old-fashioned where, for the most part, if I were to raise, I'd be trying to get the brand, which would help me raise for the next one. But outside of that, I don't know how many of these funds help. Like, I've got a friend who works for Andreessen Horowitz, and they've got like a whole...
like 1,000 people that will help
work, and like, but I don't know how much they're actually doing. And I'm also assuming if you're not like the top 2 or 3 in their portfolio...
they don't care.
Yeah.
Well, actually, what usually happens is that your top 2 or 3% of your portfolio, you don't do anything for them. Because they don't need your help.
But then the rest, you're probably like, how do we...
The rest of the time you spend like trying to help your other companies that do need help.
Executive headhunting.
Yeah, I mean, a lot of funds will help with like strategy and headhunting and opening the door to potential customers.
Do you think they're good at that?
I think some funds are good at it.
I mean, look at Josh James when he started Domo. He started Omniture, he had tons of cash. I would argue that Domo was a much more difficult beast than he anticipated, and he was a seasoned founder. He just took a few years off.
I was talking to a VC once, and they said that the best startup is number 3 for an entrepreneur, assuming the first one is marginally successful. Second one, always avoid, because they'll always go into it with a lot of hubris. And then fund the deal, company 3, like they've kind of learned their lessons across the first 2. And those tend to be the biggest success.
So if you count Codebase, if you don't count my first business, which is a lawn mowing business, I'm in my 3rd business.
Yeah, and look at Codebase. It's crushing it. So if you think about what a VC does, you are like stepping out on a limb and saying, I'm going to give money to this crazy idea because this is the future, right? And like, yes, entrepreneurs are also essentially saying the same thing. They're like, I'm dedicating my life to this, like this thing. But like VCs do that again and again and again and again when they make investments in subsequent companies. And if you don't have like confidence,
it has to be soul shaking.
Yeah, I mean, you got to be confident, right? And so I can see, and then you layer on top of that they say no more often than they say yes, and they can come off as very, very cocky and arrogant. Because it's like, if you're an entrepreneur, you're like, I've dedicated my life and soul to this thing. How can you tell me my baby is ugly? You're so arrogant, rah, 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 right?
I mean, and maybe it's a two-way street. Maybe I was on the angel side, which is like pseudo VC, and then I'm now a founder that's specifically stayed away from funding. Yeah. Every now and then I'll be like, I wonder how my life would be different. Yeah. But generally, I'm like, you know what? It's easier to go close another contract than it is to go, kiss a VC.
Yeah. No, it's fair. And look, like, I think you are right to an extent. Like, there are VCs that don't really empathize with the entrepreneur, right? They've never been through it. They don't understand how much it sucks. the highs, the lows, the mental pressure, and they just, sit in their ivory tower. But, look, I think that day is going away because entrepreneurs can get capital from a lot of different sources. And so, historically, it used to be the competitive advantage was capital, right? I got money, so come kiss the ring, right? And now entrepreneurs are like, yeah, no, there are a lot of places that have capital, right? You've got capital, but so do all these other people and platforms, and I can sell my product, and I don't need as much money to begin with, right? All of these things, and all of a sudden, like, that's not a compelling competitive advantage anymore.
Any other thoughts on this, Peter?
In terms of the future of venture?
Yeah, the future of venture.
Look, I think the thing that's challenging with venture is that it kind of comes and goes in waves, right? And, it's like history. It never repeats, but it rhymes.
That sounded like very profound. I've never heard that phrase before. If you were to anoint the industry and change it right now, what would you do? How would you change the industry? Is that too big of a question? I saw that your eyes just like...
That's such a big question. Yeah, because to me, I believe in markets. And so it's hard for me to say like...
That the market's not
It's hard for me to
efficient.
be that arrogant to say like, oh, I know exactly what needs to happen here.
What would be what's the first thing that comes to your mind,
because I believe to a certain
though?
extent, like what needs to happen is happening and is playing out, right?
And so you're seeing people responding to Tiger Global, which sounds like it's just they're taking much bigger bets much earlier on.
And paying higher valuations, yeah.
So
essentially what they're doing is they're saying, okay, and this is one of the things that I have tried really hard to understand better, is that when you work in venture, especially for longer than like 5 years, it's hard to see the potential in the long run.
Okay.
So
keep going.
I'll give you an example, right? Like we looked at SpaceX back a number of years ago, and it was at a $10 billion valuation, and they did like $1 billion in revenue, and at the time we were like, wow, 10x on a rocket company, like that's just feels so expensive. And in part of my head, I was like, but I think this company could be worth $100 billion, right? Today, SpaceX is worth $100 billion. The reason it's worth $100 billion is because some investors believe that it will be worth hundreds of billions into the future, right? And that was not something that like I believed when we looked at it, right? I could see it getting to 100 billion, but I didn't know that, right? If I could believe it could get much bigger than that. But the thing is, like the whole global economy is opening up.
Okay.
Right? You've got like, I don't even know how many companies that we've looked at or we've invested in where the employees are spread out all over the globe, right? Probably most, if not all, have employees all over the world. You have not only employees all over the world, but you have consumers of goods all over the world. And as economies grow and GDP improves, people have more disposable income, and that results in larger markets. And so I think going all the way back to Tiger Global and to a lot of these funds that are deploying billions of dollars into these companies, it's basically saying, hey, look, the world economy, like we are bullish on the world economy. It's going to continue to grow and perform and do well. And the markets that we look at today that are worth billions or hundreds of billions or whatever, like they're going to be worth multiples of that into the future. And correspondingly, these companies that we're investing in will as well, right? Like to me, it blew my mind that like we would ever have $1 trillion company. And now like we have companies that were $2 trillion.
Everything's possible with inflation.
Well, inflation is definitely part of it, but
also
these companies were also really big before inflation.
I mean, back when we were when I first got into like the SaaS space, a lot of the times the focus was what market are you going after? I remember like TechCrunch was publishing articles at the time, and their hypothesis of an article I read, which I don't know if it was right or wrong, was that the models that are working in the US are probably the models that will work in Brazil, as Brazil's becoming an emerging market. So find models that worked well and then try to transplant them. That was something I looked at, or I don't know if I looked at, but I thought about it fairly seriously. I know HireVue was a local company that focused on the US market, and I'm like, I don't know why video interviews would not be popular in a country like Brazil.
Sure.
And so, but at the time it was very like, copying and pasting, where right now I think you would just go.
But now companies just expand internationally.
And international, like some of the clients we're working with now, internationalization is one of the things right out of the gates.
Yeah.
We're going to support these 3 languages, which I don't think was something common even a couple of years ago.
Yeah, so these markets just keep getting bigger and bigger and bigger. And so then if you're Tiger Global or you're one of these big funds, you look at it and you say, if these markets are so big and they're growing so fast, then you can almost take a seed stage strategy where you're like, all right, I'm going to deploy money into a lot of companies, and I'm going to hope that one of them isn't worth $1 billion, isn't worth 10 billion. I'm going to hope that like a handful of them are worth 100 billion, 200 billion, 300 billion, right? And when you get to that level of scale, you can make up for a lot of losses, right? And so I think that's part of this thesis here, right? And plus, it's like, hey, we're going to hold these things longer, right? So part of Sequoia's whole strategy is like, hey, most of the gains that Sequoia generates for their LPs happen after a company goes public, not before, right? And so
in the public markets,
because they hold the investments longer, right? A lot of venture funds have these restrictions, like when the company goes public, you have to sell because you're not a public equities investor. Or it's a 10-year fund, so if the company takes 15 years to eventually become Airbnb, then, well, too bad. You should have sold 5 years ago, right? And you missed out on all of this value creation that happened in the subsequent 5 years. Whereas like Sequoia, and others basically look at this and say, nobody else has better information and better experience and a better exposure to this company than we do. Why would we not take advantage of that information advantage and hold it for longer if we feel like that's the right thing to do? So I don't know. I think going back to your earlier question, I think there needs to be changes in like structure of how funds are structured and how capital is deployed, and for fund managers to get out of this like old school way of thinking of it, that it's a 2 and 20 10-year fund, blah blah blah, and realizing like, hey, there are maybe different models that could work better for different types of startups and funding environments. And let's be flexible, which also means that LPs, investors in these funds, also should be thinking similarly. Like maybe there are more unique structures and we need to be like more comfortable and okay with that. If we really, really want to maximize like ultimate returns.
Okay. But as far as
that was a lot of rambling.
A lot of rambling and not a lot of specifics, but a lot of high level. I feel like we're seeing like a lot of things like with the safe note and convertible notes that are happening in the seed stage.
Okay.
I'm also not as familiar with the later stage, stage deal terms. That's something I should probably get more up to speed on. But it'll be interesting to see what's happening. But yeah, like you're seeing your Tiger Global and these others are they're anointing in theory, the winners. If there's an actual true economic market and they throw in cash, it makes it almost impossible for anyone else to compete. But then,
although not impossible, right?
And some of these companies are imploding like WeWork. And what was the dog one that imploded too?
The dog
There was like a dog walking Airbnb one. Was it Woof?
Wag?
Wag, yeah, Wag.
I didn't know Wag imploded. But
I don't know, it imploded, but I think it had significant internal issues. Yeah. Too much cash.
I mean, SoftBank went out, and I mean, that's what they were kind of saying is like, we're going to anoint the winners, right? And they made a whole bunch of investments, and some of them, like WeWork, didn't pan out quite as well as they had hoped. But others are doing very well. So, and I think that's what I'm saying. I think like the Tiger Globals looked at that and they said, hey, it's not that SoftBank totally got it wrong, right? Maybe they were a little over allocated in some deals like WeWork, but the fundamental thesis of like, let's deploy a bunch of capital, let's make a ton of bets, let's move really fast so that we become the funder of choice for entrepreneurs, right? Allows us to basically place a lot of bets in some of the best companies out there, and some of those will go on to become huge companies, right? The next Googles, the next Ubers, the next Airbnbs, the next Facebooks, etc. And if you invest and you hold on to like a Google from the time it goes public to today, like you're up hundreds of X on that deal.
How is the market changing what you guys do at the University Growth Fund?
So for us, the thing that keeps me up at night is just the speed at which great deals get done. And so that means that we have to move really fast.
Getting done.
I mean,
a week, 2 weeks?
Companies are getting term sheets like after an initial call.
Okay. Which gives you how much time to respond?
That same day. Right?
Okay.
And then they're closing. Like I've heard of deals getting closed in like 2 weeks, 3 weeks. From like the first meeting to like money in the bank, which is insanely fast.
How much time does it take University Growth Fund to close it on a deal?
We've done it in as little as a week and a half.
Okay. What's the standard?
I like 6 weeks.
Okay. 6 weeks is good.
I don't always get it. I rarely get it. I don't know. But
why do you like 6 weeks?
You don't feel rushed. You can actually get through all of your diligence and feel really good about your decision at the end of the day.
Okay.
And for us, right, we're running a student program, so it's like teaching students and having them like work through it, and they're balancing it with classes. And so for us, that six weeks is ideal. But like I said, we've done it in a week and a half.
Okay.
For the right deal.
What's been your biggest miss? Either that or you haven't had big misses.
You know what deal that I regret not pursuing harder?
Which is?
Was Divvy.
Divvy?
Yeah,
the local Divvy.
The local Divvy. Yeah.
Why?
So I had a lot of friends that were like, "Hey, you got to check out this company Divvy. Like they're doing really well." And it was really early, and I thought, honestly, I got them confused with another company, and I was like, I don't know, and I should have pursued it harder than I did. So kind of missed that one. I don't know for sure that they would have given us an opportunity to invest, so I don't want to suggest that we had that opportunity, but it's one that I wish I had pursued more aggressively at the very early stages.
Okay.
We still may not have done it, and they still may not have let us in. But yeah.
I like that honest approach. See, there's no ego from Peter.
There's a lot of ego from Peter.
I don't think there's confidence. I think there's a difference between confidence and ego. Well, awesome. Anything else you'd like to add to this, Peter?
No, this is fun. Thanks for letting me ramble.
All right, you better head off to the University of Utah and go judge those students. Their ideas, not the students. I did that on purpose.
Awesome. Sounds good. Thanks, John.
All right, thanks, Peter.